This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. This is joy, and I'm going to cut to the chase of what Ethan Harris really did. There was a small shop that went under. It was called Lehman Brothers, and he was one of a select few that provided immense stability to Lehman Brothers and the debris. After that, he migrated over to Bank of America Merrill Lynch, where he's been a force for decades, and he's retiring here. I'm going to cut to the chase. Is Moynihan aware of this? Because Brian comes on Bloomberg. Well, I really think real GDP is going to do this, and he's looking down at Ethan Harris and stuff. Did Moynihan allow this?
Yeah, he's allowing it. You know, one of the great things about our CEO is that he does read our stuff, and he really cares about his research department. So I'm going to miss that. I mean, one of the great things about working at B of A is that the firm really cares about research. I've been busting. He's selling this like, it's just great. Brian, you can't come out in front of the camera. Stay over there, Brian. What's important here is you wrote a magnificent book years ago, Ben Bernanke's Fed, that was a piercing book with your experience at the Fed about the dynamics of the Fed. What does Jerome Powell's Fed look like as you go to write your next book? Yeah, so I am going to finally write that next book you've been asking me about for 15 years. You know, I think what we're going to see is a turning back the clock. I think the experiment that the Fed did with this 2020 new framework didn't work. And we're going to see a turning back of the clock to something that looks more like a Ben Bernanke or a Janet Yellen Fed. I don't think it makes sense for the Fed to do what they did, which is wait to the last second, wait for inflation to be really underway, and then start to hike interest rates. So I don't expect radical change, but rather kind of just go back to the old model.
Well, the old model, is it the old model meaning 10 years ago, or is it the old model 40 years ago, which was very different? And that's really the big debate we've been hearing about. What's your view of how we're going to look back at this moment in history? Was it a sea change that ushered in a new era of high inflation, or was it a pandemic-induced blip that's going to go back to what we were seeing 5 years ago?
Well, I think the Fed has demonstrated that they learned a lesson here. They started very late, and you'll hear that from Bill Dudley later today. He was one of the people arguing they should get moving. And they started too late, and then they did an incredibly aggressive catching up. And that was a signal to me that they understood that they'd made a mistake. Because you don't want to be going 75 basis points a meeting. It's very dangerous normally. But if you're way behind the curve, you catch up. So I don't agree with people who say they're going to compromise on their inflation target. At his press conference, he repeats over and over and over again. Every chance he gets, he says, we're serious about hitting our 2% inflation target. He's putting his credibility on the line. He does not want to be Arthur Burns. He wants to be Paul Volcker.
What have we learned, though, about this aggressive tightening? You're saying they don't want to do that. They did that. Nothing broke. You could argue, okay, we saw some bank rumbles, but right now we're looking at housing reaccelerating, seeming to have already bottomed, and much of the economy performing better than expected. What do you make of that?
Well, I think that they were up against some very big tailwinds in the economy. You had all that massive excess saving left over from the fiscal stimulus during the crisis. You've had pent-up demand for workers with all these job openings. And so the Fed did achieve some weakening in parts of the economy that are interest sensitive, but the consumer just refused to roll over. You know, jobs were great. The savings were high and they could spend their savings. So I think it's delayed the weakness, and we still think a mild recession, probably early next year. But like a lot of other forecasters, we've been forced to concede that it's not here. It's going to take a while. I don't think it's the end of the world. There's this hard landing, soft landing debate. Come on. If you're forecasting the unemployment rate going from 3.5 to 4.5, that's not a hard landing. That's great. That's normal unemployment. Yeah. So it's the people I disagree with are the perfect landing crowd that says, oh, you don't have to have any pain at all, that inflation's going to go away on its own. no adjustment in the economy. That I disagree with, but it's going to be a soft landing, either bumpy or a little more bumpy, but it's not going to be a hard landing.
With our new data capture, with all the noise that's out there, is there too much communication? We opened the show with a beautiful vignette one of our interns put together of all these Fed speakers speaking. Is there too much communication?
Well, I mean, that's the structure of the Fed, right? It's a very...
Not the old Fed.
Well, when Greenspan dominated, he suppressed the rest of the committee's openness, and so that's changed under the new Fed chairs. So there's a lot of information coming out. Mm-hmm. I think the business reporters are a bit too hyped up about this whole thing. They keep talking about hawks and doves and all that.
Hawkish pause.
Yeah. Well, look at the Fed. There's been virtually no dissents through a period of way behind the curve, fastest tightening in history, and now data dependent. Nobody's dissenting.
Right.
So the idea that you need to get all pumped up about what some dove said or what some hawk said, I think is way overdone.
You have been prodigious in building careers. I mean, what you did for Michelle Myers, she went off to some charge card company to, I don't know what she was thinking. Moynihan's yet to recover from Michelle Meyer leaving. But the bottom line is you've built careers. You came out of the Newtonian calculus at Clark University up in Massachusetts. The idea here of math matters. Is there too much math now in the game?
Well, not in the part of the area I'm in, right? If you're a Fed economist or a street economist and you're trying to figure out the economy and policy, we all understand that it's a lot of storytelling and historic analogy that you don't want to get too crazy about the modeling. Yeah. In academia, there has been this drift into mathiness where you impress people by the complexity of the model. Yeah. But it doesn't really work in the real world. So there's become a split in the economics profession between people who are practical economists and the ones that do the mathiness.
We're speaking with Ethan Harris of Bank of America Securities after more than a decade at Bank of America, who is retiring as of this Friday, I believe. I believe this is your last interview that has been scheduled, and we appreciate you sharing it with us. I want to pivot a little bit because we're talking about looking back over a trajectory of a career and understanding where we are at this moment. Do you think that in the future, people coming into this industry will be working in an office to the same degree? Do you think that will be one of the big sea changes that persists over the next decades?
Well, I think to some degree, hybrid is the new normal. I think there's a battle going on between corporate leadership and the staff about whether that's really what they want to do.
Harris getting himself into trouble. He's on the 2-day countdown, and HR's compliance is like, what's he saying?
Yeah, so maybe today is my last day. But no, I'm not talking about Bank of America. I'm talking about in general, and there's a trade-off, right? So it's definitely not good for developing new people to have everyone sitting in their pajamas at home. That's not a good thing.
May we quote you on that?
Yeah, exactly. If they don't have their pajamas on, then you're really in trouble. But anyways, so you don't want to be entirely at home. On the other hand, in my case, I have a crazy New York City suburb commute. And so for me, I'm more productive if I'm working hybrid. So that's really the debate. It's about what's the most productive model? And I think in many industries, hybrid is going to end up being the thing.
A sensitive question as we talk about some of the earnings of tech companies and artificial intelligence. Is ChatGPT going to be your new research assistant?
I tried it. And in fact, a friend of my son tried it out, and he put my name in there and started asking questions about me. Now, I've got a lot of visibility in the press and stuff. What I found with the chat app is that at first it gave very good answers. It found my bio and wrote it up in better language than I did. But then as my son's friend kept asking tougher questions, it started returning nonsense. It started telling me that I'd won some great prize in Japan for there's some like it's like a peace prize or something in Japan, and so if you pushed it and tried to get it to get really interesting, it gave you junk.
I've got to ask you this because it's the heritage. Can you give all of our global Wall Street audience a vignette of what it was like, not the final days of Lehman, but a week after Lehman, a month after Lehman? Give us a window and how you and others had the leadership there to pick up the pieces.
Well, I mean, everyone was in shell shock, and I was lucky. My team got picked up by Barclays, and so we had a life raft, lifeboat to jump into. But you were kind of in this environment where you had both these forced marriages going on in Wall Street, which are never fun, at the same time that you have this incredibly demanding and interesting and challenging world you're trying to forecast, where the economy is just collapsing. And it was an amazing time, and you just had to kind of, lean on each other a bit, I guess.
Ethan Harris, thank you so much with a huge commitment to the show. It's just been great.
Francis Donald and Manulife with us.
Here.
Francis, I just can't believe how transparent TK just was over a legal issue.
Well, in the CFA curriculum, they talk a lot about transparency, and they talk about how you shouldn't even give the appearance of conflict. So, Tom, looks like you've done a great job there.
Yeah, but the other issue is who let her in? The major issue here is insider trading is not as clear-cut as the public thinks. It can get really back and forth about who said what when. I was stunned by the allegations, I would think. Francis Donald is with us right now. We say thank you. Thrilled you're here this morning. What are you writing about this weekend on Y = C + I + G + NX? What's the dynamic there? Is it investment, or is it the mystery of this buoyant consumer?
We are trying to stick to process even as price moves against our base case, which is that, yes, still all of our leading indicators and our economic model suggest that the best base case scenario is indeed a recession in Q4. Now, that's not actually the game. The game as an asset manager is not to say whether there's recession or a soft landing, but to get a sense as to what markets will price in and out over the next 3 to 6 months. So what we're talking about is that in the next 1 to 2 months, we actually see economic data that will still give the appearance of soft landing. That's an opportunity to chase some risk. But if you're looking further out, if you're looking beyond the next 3 months, we still have to maintain this call. It doesn't feel good as everyone moves towards the soft landing thesis, but when you stick to the leading indicators, we have to say that is the best base case.
What does it mean to lean into risk right now? What are those areas?
Well, there is, even as a macro strategist, as an economist, I can say sometimes you need to participate in momentum-driven rallies. This happens. Macro is not always the primary investment driver. Again, that is not the most comfortable thing to say as a macro strategist, but an overlay, and it matters much more at inflection points. I do not believe right now we are at an inflection point, even though today is a Fed meeting and it may feel that way. That inflection point is to when that recession will probably come back into the story is probably 3 months from now. So if you want to play off momentum, sentiment, and technicals, now is the time to shine if those are your strengths.
Did somebody overnight push their recession call out to 2025? I'm going to say Goldman Sachs, but I'm making it up.
I didn't see that.
Somebody out
25.
there. I mean, everybody's pushing it out. Not 2024.
Well, they have done all year.
Yeah,
They just push it another 3 months. Another 3 months.
Can you raise it to 2026?
Sure, and I'm sure that if you asked any economist, they would have some sort of recession over the next 5 years, because I don't believe that cycles are necessarily dead. But it's a good question, and we ask ourselves this all the time, which is, why hasn't the recession that everyone's forecast materialized? It's probably because, and again, you have to look at what a standard economic model would tell you. You also have to say what may be not true about that model, or what's different about this environment. And a lot of strategists have said this time is fundamentally different. My view is that, well, you can't throw the baby out with the bathwater. There are elements of this story that are going to be very different. This recession that occurs later this year and into 2024 will look slightly different. Unemployment rate probably not going to rise to the same extent. And you do have to question, why isn't it here yet? That's probably because you have what we like to call cycle extenders in play. Things like labor shortages, excess savings. We're not talking, you don't need a PhD to figure out that there are things that are different about this story, but negating all of history, negating all of the power of leading indicators, to me, is not prudent in this environment.
So Germany has a recession.
Yes.
Europe still has an inflation problem. As you anticipate that growth downturn in the United States, do you also envision that maybe we have a sticky inflation problem too simultaneously?
Yeah, absolutely. And this is actually what concerns me more. We spend so much time talking about recession or soft landing. There are a heck of a lot of environments in between those two things. And frankly, if I'm an asset manager, which I am, and trying to figure out how to invest over the next 5 years, a classic recession rebound, we have a playbook for that. You can do well in that type of environment. What concerns me more, what we don't have the playbooks for, is what Europe is experiencing now. Sticky high inflation with no growth. One thing I'm worried about is actually this concept of the soft landing being green light, being the most bullish outcome. I'm not sure that a soft landing is as bullish as everybody makes it out to be, because we have 4 cuts priced in for next year. And if we don't get those because the economy is all clear, we have a re-rating to be made in a variety of risk assets. I'm not sure that we've really thought through what does soft landing mean for equity markets. It's not as bullish as it may appear.
How much do you think it's a bear market trap almost to lure people back to the 60-40 ahead of what you just explained in terms of the vulnerabilities in that type of maybe soft landing, but high inflation, no growth kind of circumstance?
Well, again, it really depends on your timeline. If you're operating on a 1 to 2 month timeline, it's not a trap, it's an opportunity in order to really leverage what we'll probably see is some cyclicality, some cyclical bounce in things like manufacturing data. But if you're a longer term investor, absolutely you should be looking at these bullish runs as opportunities to add back to quality and maybe reduce your risk. I think it's also going to call into play why there's a lot more focus on alternative assets and private assets. Because in this type of environment, one that Jon is describing as slower growth, recessions with sticky high inflation, we're going to be looking for asset classes that really reduce that volatility and are less correlated with the 60-40.
Asking for a friend, is the meeting this afternoon, is the press conference this afternoon a snooze fest?
I hope for markets that it is, and I would expect that Chair Powell also hopes that it's a snooze
fest. Well, what's
fest.
your prediction here?
I don't believe there is anything that Chair Powell could say today that would convince the market to take out rate cuts from next year. And that's because just about everybody recognizes that the Fed does not have the luxury of pivoting. What's happened since the last meeting? We've got ag prices surging, inflation expectations in the longer end of the curve are up quite a bit, and financial conditions are easing. He has no choice. He cannot go dovish. If he does, it'll be a little bit of an accident. So this is a market that's probably going to start putting a little less weight on what the Fed says and more on what 2024 is going to look like.
How do you think he manages what is increasingly looking like a broken consensus on the FOMC?
Well, that's a tough one. Probably like a lot of strategists are doing, which is coming out with a base case and then thinking through all the other scenarios behind the scenes. Goldman does a good job about talking about a base case and then a probability weighted base case. So the Fed can start talking a little bit more about scenarios, but it comes back to the issue that the Fed has to control inflation expectations. I think this is a big theme for the next 5 years, that central banks will have to have a moment where they admit we don't know what's always going on. And secondly, we can't combat all elements of inflation. That's going to be the story for how markets trade around central banks over the secular theme.
Francis, this was awesome. Come in the studio more often.
I'd love to.
I love it. Francis Donald of Manulife.
Right now on the bond, Jon, I'm going to bounce it back to you here. It's Kathy Jones is with us. She's chief fixed income strategist at Charles Schwab. And I think this is underplayed, Jon. There's been real stasis here, the real yield stasis, 10-year stasis. All my radar's up on the bond market because it's boring right now.
Kathy, let's get to it. Will it be boring at 2:30 Eastern time?
Oh, I'm sure we'll get some excitement, you always do. But, as you said, that's widely anticipated. The Fed's going to hike, and then what's forward guidance going to be? And I think the expectation is they'll sound hawkish, but they may indicate a pause. How does that get parsed out in the Q&A session? What does Paul kind of communicate here? Will we get a dissenting vote, possibly, or at least a hint that a handful of Fed officials are not on board with more rate hikes? That could communicate a lot to the market.
We've spoken to a couple of people this morning who think that inflation reaccelerates later this year. I just wonder if that's in your base case and what it would mean for a yield curve right now that's already deeply inverted?
Yeah, we don't have a real acceleration in inflation built in. There's a lot of disinflation in the pipeline that is still flowing through, especially when you look at wholesale goods prices. And we're not seeing that huge amount of pressure on the inflation side. Of course, you have oil, which is going to be there. But ex-food and energy, it doesn't look like we're seeing a reacceleration at this stage of the game. Growth is still substandard. It's been 5 quarters of 1.5% GDP growth. It's really hard, I think, to push the inflation narrative from there.
Would it be bad if Jay Powell came out and said, we have no clue. We don't know where this is going. We're going to pause. Raphael Bostic is going to dissent because he probably will, because he's been the lone dove out there that's been pretty vocal. All of us aren't sure. Here's what we're watching. Call it a day. Why can't he just do that?
I sort of wish he would, to tell you the truth. But I think the Fed they have forecasts, they have to communicate some sort of confidence about going forward. But, the truth is they don't know. They never know. Nobody really knows what's going to happen in the next few quarters. They can only follow the indicators and the trends. We have, as Tom mentioned, very high real rates. We have tightening credit at the banks a lot. And we'll get the senior loan officers, I think, pretty soon. I would imagine the Fed has done some work on what's going on behind the scenes at the banks. We're not waiting for the quarterly report to come out. So they may have a feel for just how tight credit is getting. So those are all going to go into the equation. And then QT continues. We've still got that going on in the background. So tightening is still happening, even if they pause. And I think that may be part of the message that comes out.
And one aspect of this, and we're seeing this in terms of 2-year yields going up as high as they have, higher than the previous meeting, even as risk assets continue to rally, can they, with conviction, say they are not going to hike next year and really push against people who are saying, well, it might be a recession? Could they give some indication of how high the bar is for them to really ease?
Well, Powell, I think it was last November, outlined 4 things that he was watching for a pivot, for a change in rates. And one was this disinflation from the wholesale markets to retail pricing. You could sort of say, yeah, that's happened. He's talked about a sub-trend GDP growth for a number of quarters, where I would argue we've probably had that over the last year or so. He talked about slowdown in housing prices, and we're starting to see that, but it hasn't flowed through to the data. And then I think that there's the wage data. And so we have to wait for that. So I think they could outline the criteria and then say, this is what we're watching. I think they've kind of outlined it in general over the last year or two. But we're waiting to see all of the boxes get checked. We're waiting to see everything kick in. And I would argue that, the labor data is probably the final one.
Let's go from 60,000 feet down to 6 feet. I'm over a kitchen table this weekend. I'm still not recovered from the bond debacle of 18 months ago. I thought bonds were always supposed to go up. What is the retail recommendation to participate in fixed income out to 2026?
So we like extending duration either with a barbell or, let's say, a ladder.
Ladder out is appropriate?
Yeah, laddering is fine because it takes you out of the game of trying to time the market.
Give us a duration gap on that, a maturity gap on how you ladder up.
Yeah, we like a 1 to 7 year right now, but it depends if you're in the muni market. You might want to go a little further out because the
like
curve
30
is
years
sloped.
Or the Austrian piece?
No, Austrian pieces. No,
that's what
30
I did.
years.
I'm killed. This is a really important lesson, John. You ladder out with someone, an adult like this, and retail's laddering out. Should we go out 10 years or 20 years? Because they're yield hogs and they want to pick up yield. Ms. Jones is laddering 1 to 7. That's a massive lesson right there.
How's that century bond doing
it's
over in
killing,
Austria?
It's just
killing it or killing
it's brutal. It's killing it.
Yeah, I was going to say.
It's just,
It's amazing, at the time when all of that stuff was being issued, when Argentina came to the market, it was one of those moments where everyone knew. Everyone knew. It wasn't like you had that contrarian thought, well, this is a bubble, this is bad. Like, everyone knew it was. They also knew that negative yields was deeply unsustainable. They just got more negative and persisted for a long time, Lisa.
This is when you know something's truly a bubble. When people say maybe it's a bubble that can just exist in perpetuity.
Totally.
And bonds have a new place where it's really capital appreciation and the price appreciation, not the actual coupon, which is nothing.
Yeah, we were going to the bond market for capital returns.
Yeah.
And a monster bond market rally. That yields are negative, great, but they'll be more negative. and prices are
that's
going up.
An arch.
That was the story, the last 10 years, Tom.
I mean, it is. I mean, the whole last 10 years, last 16 years.
Kathy Jones,
as well.
thank you. It's good to see you. Kathy Jones at Charles Schwab there. Dan Ives alongside us this morning, and good morning, Dan.
I couldn't tell. My eyes
It's good to see you. I thought you were going to say at the corner of my eye I saw this fluorescent jacket, and that's when I met Dan Ives. Dan, I always reflect on this video, and you've heard this story before, forgive me, but you remember the clip from 60 Minutes in the late 90s, and there's this very sort of smug journalist asking an analyst about Amazon being bigger than Sears and saying, bigger than Sears? And you look back on it 30 years later, 25 years later, and it sounds ridiculous. So in moments like these, I try and be maybe a little bit modest about what I don't know and try and be a little bit, humility is the word maybe,
yes.
Bramo, just, try and have some humility about this AI moment. Dan, do you think we need a bigger dose of humility about how big this could be?
I mean, I think it's even going to be bigger than the street is even anticipating. And I think what we saw from Microsoft and Google just further confirms what we saw from NVIDIA. I mean, the use cases are exploding across the board. And I look at this as a 1995 moment, biggest transformation that we've seen in tech in 30 years. And I think that's why this is just what's going to lead, obviously, despite Fed and macro. It's the start of a new tech bull market, in my opinion.
There is the nuance, though, when people start to dig into what does AI mean and which areas are the investable and most lucrative areas. Is it going to be generative AI, where basically you can go to any retailer, put your avatar in, try on clothes, and then order things? Or is it something else? What are you looking for to determine who the winners are going to be?
Yeah, well, right now, New York City cab driver knows that the first derivative, NVIDIA and Microsoft. And I think that's been proven again, top of the mountain. Now it's all about who's second, third, fourth derivative. It's really software and chips. When I look at names like Salesforce.com, MongoDB, you look at Snowflake, I think that's really just tip of the iceberg. I think others across the chip ecosystem, and what we're really starting to see now, it's all about use cases. That's why right now investors, they're just looking. If you look at it's expensive on next year's number, it's really looking out 2, 3, 4 years. I believe this, from everything we're hearing, it could be 8 to 10% of budgets next year for IT, from less than 1% today.
So if you take a look at the price action today, with Microsoft shares lower because they didn't necessarily deliver on the profitability of AI yet, they can't. They're investing still, and they're not delivering as fast of some sort of investment on the cloud space. What would you say to investors in terms of how they should look at this valuation, how they should look at some of the rejiggering of the top executives, and put a price target on that?
Yeah, it's a great question. And that was all my conversations last night and even earlier this morning with institutional investors. Look, Nadella, the tactician, the Hall of Famer. I mean, this is just getting the popcorn out ready for what I view as actually an accelerating growth story. They're not going to, they're not Cook style going to give their playbook away. They're going to keep this conservative, and I view just a sandbag special as they continue to just beat numbers over the next few quarters, which is why I believe Microsoft, a year from now, it's going to join Apple in that $3 trillion, I think $3.5 trillion, what I see in a year.
George Hammond writes in the FT today about the AI crew. He's got Anthropic, Google, Microsoft, and OpenAI. Okay, I guess that's the new industry organization around this. The Luddites are going to show up. We're going to do a 19th century redux here of the damage of AI. How do these giant companies with the profitability they have handle the 21st century Luddites?
Look, I think stronger, you're going to get stronger. There'll be some self-regulation. But ultimately, if you look from a regulatory perspective, they're going 20 miles an hour in the right lane. Technology's going 100 in the left lane. So I think really the stronger going to get stronger. If you look at Microsoft, you look what we see out of Alphabet, that was a huge flex the muscles quarter for them.
Oh, I like the CFA talk.
And
flex the muscles.
It was a huge flex the muscles quarter. And that's, look, this is one, if you're a bear now coming a little out of hibernation mode, thinking that you want...
Why are you looking at me?
No, if you're a bear coming a little out of hibernation mode, right. I think ultimately what you saw from tech earnings, just more and more bullish.
Okay.
And I think next week is going to be the golden moment.
That's where I want to go.
Cupertino
I don't
next
care
Thursday.
about all this AI talk. I want to know about next Thursday, Amazon and Apple. Amazon's not in that list of AI companies. I think they're in the cloud. Apple certainly isn't. How does does Apple embrace AI? How did they get on this list of these companies?
Cook continues to play chess, others play checkers. And I think what we believe it's going to be an AI-driven app store. Gurman's hinted at some of the AI technology, but I ultimately believe the next 1-2 years, that's just going to be a further penetration story. Adds $30 to $40 some of the parts to Apple.
Can it protect their margins down the income statement? How many beeps can Apple pick up on EBITDA, let's say, out of AI 5 years out?
AI combined with chips, you're talking incremental 300-400 bips. That's just
300 bips
300 to 400 bips improvement because they own their ecosystem plus AI being pure software
margins. How quickly do they get to $4 trillion market cap off a 300 bip improvement?
I believe we will be sitting here in early 2025 getting ready for Super Bowl and Apple will be $4 trillion.
Okay, breathe. So I acknowledge that in the late 90s, there were some real things that we didn't appreciate. We also got sold a lot of BS. So can you explain to me, and I wish we could curse on this show, could you explain to me what is an AI-generated app store? What is that?
So that's ultimately going to be, whether it's health, fitness, any types of apps developers are going to build, they're going to be AI generated with all what I would call generative AI technology that will be built within the App Store. So ultimately, any Apple user will be able to download those apps for developers. Just like we have the App Store today, the next version of that is going to be an AI-driven App Store that I believe Cupertino will ultimately come out, and I think they're actually starting the concept of it with Vision Pro and ultimately a new form factor.
In the meantime, it's not going to be about that. It's going to be about how many iPhones they sell. For a long time, you've been bullish on this upgrade cycle that kind of never was. And it's always been the justification for why the stock's got to go further. So a lot of people that haven't upgraded, they're going to buy the iPhone 13, 14, 15, and then it kind of remains the same and pretty stable. What's going on there?
Street numbers have moved up 15% on iPhones. So the thing is, the bears ultimately thought sub 200 million, but yet they sold 225 million because they continue, and Keene, the tactician, knows as well as anyone, they continue to underestimate the golden install base of Cupertino, which is why I view this as a mini super cycle playing out. And I think Apple next Thursday, Cook on the call. That's just going to be further what I've used fuel in the engine for this upgrade cycle.
Here's the upgrade cycle. I just took a photo of Dan's shoe. The saturation on this phone is so superior to anything.
And it still doesn't capture the colorfulness.
It doesn't capture.
And look at that camera the technology and the chip.
Isn't the Samsung camera better?
Yeah, but this is a really important point. Overnight, we got 30
seconds. Hasn't it always been better?
When does Samsung just give it up? The report overnight was not good.
Look, Samsung, Everest, like uphill battle, another sort of black eye for them. And I think ultimately it continues to be more and more share gains for Apple. And I think, look, Samsung, it's a continued struggle that they have again and again.
Dan, it's good to catch up. I know we're going to do this together in the next week. I'm looking forward to it. Thank you, buddy.
I'm going to put this out on Twitter. Ives, unfiltered.
Unfiltered?
Yeah.
Just a picture of his sneakers?
Yeah.
Okay. Dan Ives of Wedbush.
This is the conversation of the day. If you are in Local 25 in Boston and you grew up with 3 generations of Teamsters, and then you take on all of what we know, all of the decades and decades of history of the Teamsters, and you revolutionize unions in America, you come to a moment like we saw yesterday with Big Brown UPS. Sean OBrien has provided the leadership on this. He's general president of the International Brotherhood of Teamsters and joins us this morning. Sean, congratulations on this pre-vote agreement, this handshake agreement you have with UPS. In your comments and others, you say Amazon is next. Where do you move from this successful agreement to the next transportation company? Is it Amazon?
Amazon is definitely going to be a target to organize. We're going to take this historic agreement and use it as a template to show the Amazon workers what they will receive when they join the Teamsters Union, and we organize them.
The significance of this agreement speaks to a new Teamsters. Does all of America, including I'm going to call capitalist America, misunderstand the modern labor dynamic?
Well, I'm not sure if they misunderstand it, but the one thing that we were able to achieve with this agreement is that we showed the entire country what you can do when you have the support of your rank and file members. I think we put some more energy into the labor movement, but also we got the largest deal done without having to strike the company. So I think we added credibility to the process, and also, more importantly, we set the tone for what organized labor can achieve against corporate America in these high profits, and we want to be rewarded. Our members need to be rewarded.
Sean, you said that UPS blinked in a statement to your 340,000 members. Do you get the sense that corporations are more willing to blink now because of the labor shortages, that your negotiating power is stronger than it's been in a very long time?
Yeah, I think we've got tremendous leverage right now because we can leverage our ability. We've provided tremendous support during the pandemic, providing goods and services. And I think now it's the time to capitalize. I mean, far too long, we kept seeing CEO pay increasing and stock options increasing, and our members' pay, not just in the Teamsters Union, but throughout the labor movement, were not increasing. So I think right now we have the ability to really, really showcase and be the model and encourage other unions to stand up and fight.
How do you decide, Sean, when you're negotiating what the threshold is between workers' rights and workers' pay increases versus the health of a company, of what's sustainable over a longer period of time, given that prices are increasing and this is an inflationary environment?
Well, I think first off, we had a great situation here with UPS. Because of our members and their hard work, they made $100 billion. So a healthy company should share the profits and should share the wealth. Look, we take every negotiation. We do a deep dive. We're a lot more sophisticated than we were 30 or 40 years ago. So we obviously study the finances, study the projections, and make certain that, we understand what we can get out of these companies. But, far too long, everybody uses the economy saying, hey, we could probably go into a recession. And that's all well and good. We always come out of bad situations at some point in time. So we always just stay focused on what our members need. We're not too concerned about Wall Street or anything else. What is going to help our members survive and provide middle-class opportunities for their families.
Mr. O'Brien, in the time that we have left, your sons are involved in this. Your father was Local 25 as well. You've lived this for your entire lifetime. How do we change the atomization of labor in America, the deunionization of America? Do you perceive a sea change with this agreement?
Yeah, I think this agreement's going to be a template to show the entire workforce, union and non-union, what you get when you join a union. You're going to get wage increases, you're going to get health and welfare, you're going to get pension, but more importantly, you're going to get dignity and respect and a future. This agreement that we negotiated, we protected against technology. We provided for full-time job opportunities. That's the leverage that you have when you're working for the best contract in the industry, and we achieved that.
Sean, we're just going to run out of time here. I want you to speak to the Bloomberg Surveillance Office. There are a lot of fancy people. Let's be blunt. They're probably less pro-union than many. What do the Teamsters bring to capitalists to provide for better productivity?
Hey, we bring the best workforce in America. We proved that during the pandemic, not just in UPS, but picking up rubbish, delivering groceries. We provided goods and services. We proved we were essential, and we're going to continue that post-pandemic, and we've got the best workforce in America.
Sean O'Brien, congratulations. All I ask is after UPS, you do something about the Red Sox. Sean O'Brien, Local 25 in Boston, and also with the International Brotherhood of Teamsters there as well. Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.